I yield back my 4 seconds, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Chair Brown and Ranking Member, and thanks to all of you for being here today. Let me just follow up a little bit. Mr. Barr, I really appreciated the candid appraisal that you provided, that the Fed provided in your review of what happened with these banks. And part of what I took from your appraisal was that decisions made and actions taken prior to you being at the Fed had a distinct impact on the ways in which regulations were enforced and supervision was deployed. Do I have that right?
Yes, that was one of the findings of the report, is that the 2019 tailoring rules contributed to lower supervisory standards with respect to firms like SVB.
Right.
Including lower capital requirements, lower liquidity requirements, less stringent supervision, and other measures.
And I think that's just the reality. And, we are in the business of trying to figure out how to fix these problems. And I appreciate the tone with which you approach this discussion, which is to be kind of on the side of solving problems and not just identifying problems. And so I just want to thank you for that. This gets to kind of the thing that I want to follow up on a little bit. Some of you have heard in this committee that I come from a family of community bankers. My grandmother was a president of a small community bank back in the 1940s and 50s and 60s. And I remember when I was a little kid, the frisson that would go through the bank when the bank examiners were coming to town. It was a big deal. And you didn't just ignore the examiners. You listened to what they had to say. And if they saw a problem, you fixed it. And I suspect that the hundreds of community banks in Minnesota would say exactly the same thing in 2023. So, what I'm struck by is I think about what happened at Silicon Valley Bank, how they didn't have adequate interest and liquidity risk policies in place. The board wasn't fully aware, it appears, of the exposure of the bank as interest rates rose. Management wasn't held accountable. In fact, as Senator Van Hollen was just identifying, management appeared to be rewarded for taking additional risk. And so I'm just so struck by the lack of urgency. Why was it that these executives seemed to think that the guidance, the deficiency ratings that they were getting were just like another thing that happened, as opposed to the thing you just ran around town and fixed as quickly as you could?
Senator, I think you raise an absolutely critical point. And like you, my experience has been most banks all over the country, community banks, regional banks, they first of all, don't get themselves into these difficulties by and large.
Right.
And if they do get themselves into some difficulty, they are very focused on responding promptly to supervisors, to examiners' concerns. And in this instance, that is not the case. The bank took far too long to respond in appropriate ways. And as I said earlier, in some cases, went in the opposite direction. They kind of changed the test. When the test resulted in them failing the test, they tried to change the test to make it less conservative on interest rate risk, on liquidity risk. That's not a sign of a firm engaging in appropriate behavior.
Right.
They took off interest rate hedges that would have helped them have more resiliency in order to boost short-term profit. That's not a sign that they're taking these measures seriously.
And I appreciated in your in the reports that you identify the need for the Fed supervisors to bring more, as you say, agility and forcefulness to the to this process. Because as I think about my grandmother's community bank, there was no question that if they didn't follow through, there was going to be accountability, and that's what seems to be missing here. There just seemed to be no sense that there was going to be accountability if these executives didn't do what they were being asked to do.
Senator, I agree. Senator Kramer earlier used the analogy of the yellow card. I think a lot of yellow cards were issued, but not enough red cards.
Right, exactly. Well, to me, that is the avenue that we really need to look at, both from the question of accountability for the bank, but also accountability for the supervisors to bring that level of, as you say, forcefulness, and also to look at the additional changes that might be necessary to rules. So I appreciate that very much. Mr. Chair, I know I'm out of time, but what I will do is I will follow up separately with you, Mr. Grunberg, on the issue of the approach that you're recommending, that the FDIC is recommending around special assessments to replenish the deposit insurance fund. This is, of course, a matter of great interest to Minnesota community banks as they think about replenishing a pool of money that they had no role in diminishing. Thank you.
Thanks, Senator.